Hey, welcome back to Living in Minnesota. My name is Joe Carmack, and as you know, we love talking about home buying on this channel, but you guys have lots of lender-specific questions, so I thought it'd be fun. Why don't I have my go-to lender in? Her name is Bridget Ische. She is a genius about all things mortgage. In part 1 of 3, which is this video, we're gonna be talking about all things first-time home buyers. So if you're thinking about buying your first home or it's been first in a while, we're gonna talk about fixing your credit. We're gonna talk about how much cash you need to buy a house. We're gonna talk about different loan programs that are great for first-time buyers, and that'll include down payment assistance. So if you need some help with buying a home, Bridget's got all of the tips and tricks, so we're gonna roll into that right now. Bridget, let's talk first-time home buyers, and I want to talk about the mistakes. So you've seen a million different scenarios. You've been in the business for a long time. Talk to me about maybe the top 5 or 10 things that you see first-time buyers come in and mistakes that they've already made when they go to apply for a mortgage.
I think one of the biggest mistakes I see out there is people have too high of credit usage on their credit cards. So their balance is too high compared to their credit limit. Meaning you should always keep your balance under 30% or at 30% of your limit. So a lot of times, most people don't realize that. I think it's like one of the biggest things that people don't talk about and people don't realize. But the closer you get to your limit, the lower your score is going to drop. And it can drop significantly. I've seen back to back where I've seen somebody that has had multiple credit cards that are maxed out, that are close to the limit or over the limit, and somebody with a bankruptcy and that person with credit cards that are maxed out actually have a lower score than somebody with a bankruptcy.
Wow.
Which is kind of,
Yeah, I wouldn't have thought so. That's crazy.
Yeah.
So you're saying, to put it into, very simple terms, if your credit limit is $10,000 on your credit card, you want it to be around like 3,000, no more than 3,000 of their credit limit is being used.
Exactly. Another misconception is you do want to use credit. That's the way that you're going to earn credit, and that's the way you're going to build a high credit score, is by utilizing your credit, because that's the only way for those. There's 3 credit bureaus. That's the only way for them to actually give you a score and increase your score, is by utilizing credit. Sure. So I do think that's one misconception, is that some people are afraid to use credit and want to pay cash for everything, which is great, but then you aren't necessarily going to have the best credit score or a credit score at all. So you definitely want to use credit in a smart way. And that's by using those credit cards. And maybe you don't want to have a credit card with $1,000 limit and keep that balance at $300 constantly. Maybe you want a credit card with a $500 limit. Keep your balance at like $150.
It does seem like there's kind of an extreme between the person that has 0 credit and they're really good with money, but they're super frugal, so they don't get credit cards, and then the one that has like 10 credit cards and overuses them. Is there a perfect number? Do I want 1 credit card? Do I want to get 3 or 4? Let's say I'm 25 and I'm looking to buy my first house. Give me the perfect scenario, perfect recipe for credit cards.
The perfect scenario is to have 3 trade lines on your credit, and you want a mix of trade lines. So that's revolving credit, which are credit cards, and that's installment loans, which are car loans, student loans, personal loans, a mortgage, which obviously wouldn't be for a first-time home buyer. A mortgage will boost your credit score greatly. So you want to mix. So what I would recommend is, if you don't have a car loan, if you don't have a student loan or a personal loan, you could take one out. And one great way to do that is to open a CD, so a certificate of deposit, at your bank. So it's with your money. You can do it for like $500. You can open a CD with your money, and you can take a loan against that CD. That's an awesome way to build credit. With somebody that's like 18 years old, never have had credit in their life, that's such a good way to start credit and build credit, is to go to your bank, open a CD, take out a loan against it, and that will give you your first installment loan. And you'll earn a little bit of interest on it too. I mean, if you do it for $500, it's not going to earn you a ton of interest, but that's one little perk. And then, so if you have 1 installment loan, I would recommend 2 credit cards. Keep the limits low, keep the balances at 30%, but I would say 3 loans with a mix would be, or 3 trade lines with a good mix would be ideal.
That's cool. I've done this for a long time too, and somehow I've never heard that trick of getting a CD and then taking a loan against it. So that's a pretty cool one. A good way to dabble in it, but I'm never the type to be like, oh, just go get a new car so that you can build your credit, and just finance it. So I like that. I would say less risk than just giving a younger person a huge debt that they have to pay off. So I love that.
For sure. Yeah. Like when your kids turn 18, it's a great way for you to establish, one of the great ways for you to help establish their credit, just take out a CD.
What is good credit? What kind of a credit scores are you hoping to see? What's minimums? What's bad? Talk to me about numbers on credit scores.
So this is a chart on credit. It gives you the kind of ranges of credit, anywhere from 300 to 850 is the very highest. It's impossible to be an 850. I've definitely seen scores in the 840s, but those are people that are very, very old that have had their whole lifetime to build credit and get perfect credit.
Sure.
So anywhere from a 620, that's kind of the minimum is 620. So 620 and up, we can almost always work with. So if you have a 620, you might need to have a little bit more down payment or some assets saved up, or we could potentially get a gift from somebody. And you may not qualify for every kind of loan that's out there, but if you have a 620, we can almost always work with it. So these are the ranges. The 580 to 669 is fair. Anything over a 760 is going to be good. I would say if you're in the mid to upper 700s, you're going to qualify for the best interest rate. You're going to qualify for any loan program that's out there. So,
cool.
Yeah.
Is there I assume it's kind of harder for a younger person, 25 or whatever, to get up there. Is there a pretty good target that you might say, all right, once you've hit this benchmark, then let's buy a house, and maybe you'd hold them off before that?
I would just say a 620, because if you have a 620, you can purchase a house. And if somebody's working on their credit and there's things that we can do to help build their credit, we can always refinance. Once your credit's up, I would say every 20 points will give you kind of a different interest rate on your loan. So if somebody buys a house with a 620, they get their credit up, and I can help them through all this, but they get their credit up to like a 680, 700. We can always refinance them, and their rate's going to be significantly lower. And the other thing is their mortgage insurance is going to be lower too. So their total payment is going to drop significantly with that higher credit score.
So roughly every 20 points.
Yep.
Cool. Cool. Tell me about this. What are we looking at for how credit is calculated?
Yeah, so I just wanted to show you what how a credit score is calculated and what the mix is. So the 30% is the amounts owed. So how much do you owe on your loans, credit cards, etc. And that is also that how much do you owe compared to what the limit is. So that is a huge thing. 35% is your payment history. So what that means is how long have you been making payments on those loans? It's not just about making on-time payments, which obviously is a huge thing because that can really affect your score in a negative way. And the more recent a late payment is, the worse it's going to be for your score. So if you have a late payment that's 5 years ago, it's not going to be nearly as bad as if you had one last month and I just pull your credit. So that's payment history. It's how long have you been making payments, and also are they on time? The next is credit mix. So that's, do you have revolving debt like credit cards? Do you have car loans, student loans? You want that good, healthy mix of credit, not just all credit cards or all loans. 15% is the length of credit history. So if you're 18 years old, you just took out your first credit card, you're just not, 15% of your score is the history, and you just don't have a history built up yet. So the other thing that goes along with this is your very first credit card that you ever take out. I would suggest it to be either a store that you know you're going to shop at for your whole life. Like maybe you would be Menards, Home Depot, somewhere where you know you're always going to shop. Because you want to keep that credit card forever, because the one of the things is the credit history. So if you take out a card and then you close it a couple years later, and then you open a new card and close it out, that's really going to affect your score. So keeping those cards open for a long, long time, or even forever, is really going to help increase your score and keep it high. And then the last thing is new credit. So new credit can be okay, but it can also be it can also drop your score in the short term. So taking out new debt will drop your score in the short term. The longer that time goes on, the more that won't affect your score. So I would suggest not getting your credit pulled if at all possible. We can do, I can help you do soft pulls. But if you go to like a bank or financial institution, or you're getting a new car loan, or anybody that's going to pull your credit, that's going to be a hard pull. So that's what's going to be that 10% is new credit and those credit pulls.
Sure. Yeah. So, and I think that's why you can see represented why it's difficult for younger people to build their credit, is because between new credit and length of credit history, that's 25% right there that, you've got to have credit to get started, but getting started can hold you back a little bit. So get a card, don't get a bunch of credit pulls, and then keep it for a long time, and that'll start building up that history there.
Yeah,
not too much out on your balance. I love it. Cool. Okay, so now that we have our credit kind of squared away, talk to me about loan programs. Which kind do we want? Do we want conventional? Do we want FHA? And then I also want to hear about down payment assistance. So options that you have, options that buyers can look into, for what good loan programs are there for first-time buyers?
Yeah, so the most common loan that's out there, the loan that most people want, is a conventional loan. So that's typically somebody that has decent credit, has their own down payment. It's not a government loan, so it's a little bit less risky, I guess. Anybody that's accepting an offer on a house, so sellers are going to look through your pre-approval letter, what kind of financing you're doing. And most of them, if they see conventional loan, it's going to look better than some of the other loan types that are out there.
Like FHA. Yep.
Yes, exactly. Just historically, they're just a little bit cleaner of a loan rather than an FHA loan or like a USDA rural development loan, a loan that's not backed by the government. So typically a conventional loan, you need 5% down and you need good credit, but like you said, we have programs out there where you don't need 5% down and you can still be in a conventional loan.
Sure.
The other loan type, I would say the next most popular is an FHA loan. And that's great for somebody that might not have a perfect credit score, or that's new to credit and just doesn't have their credit built up to an 800 yet. And that one's great. The interest rate actually can be a little bit lower than on a conventional loan, just depending on the scenario.
Mm-hmm.
And mortgage insurance, like if you have a 620 credit score and you compare an FHA loan to a conventional loan, the mortgage insurance is typically going to be lower on that FHA loan. So sometimes it's going to be in your best interest to get an FHA loan. And even though FHA loans can kind of be looked down upon and they're harder to get accepted, I would say an FHA loan is still better than no loan. So if that's what it takes to get
Sure.
you in a house, then yeah,
just get started.
Yeah, exactly. The next loan type is VA. So that's for any active military or veterans. It's a great program. You can do zero down. You could buy a house with no money because you can ask the seller to cover your closing costs and
Sure.
escrows and literally come to closing with zero down.
Yeah.
They're a little bit looser with some of their underwriting guidelines as well. Some things are a little bit harder to do. And then you have that government appraisal, which is a little bit more scrutinized than a conventional appraisal will be.
Yep.
So they'll look for chipping and peeling paint. That's the biggest thing, is the chipping and peeling paint, which can be cumbersome. Yeah.
The government likes to be very picky on their appraisals. Makes my job fun.
Yeah.
Yep.
Makes it fun when you're the buyer or the seller. Yeah.
Yep. So conventional is kind of a 5% down. Traditionally, FHA is 3.5% down payment, and then VA can be a 0, or USDA is 0.
Yes, exactly.
Before we go to down payment assistance, can we talk about the other cash to close too? Because I think sometimes people hear 5% down payment, right? And they think that's all that they have to bring cash to close.
Yes.
Do you have a good guideline of what other percentage for the other closing costs that they'll need in addition to whichever down payment they pick?
Yeah, so I would say it really is going to depend on the purchase price of the house. But in Minnesota, where the average purchase price of a house is, typically the closing costs and escrows are going to be about 3% of the purchase price.
Yep.
So if you're bringing 5% for your down payment, I would count in another 3% for the closing costs and escrows.
Yep.
If
And
you're
that's what I've seen too. And I'll say if it's a lower price point, maybe you're thinking 3.5%, 4%. If it's an upper bracket, then maybe it's a little bit less. But,
exactly, because a lot of the fees are fixed fees, but a lot of them are a percentage of the loan amount as well.
Yeah.
But for the average loan in Minnesota, it's right around, and I would say even 2.5% to 3%, but 3% is a good target.
Yeah. So to recap, so you want 3% for your closing costs, and then you want 1, 5, 3%, whatever for your down payment. So people need to lump those two together. In our world, we kind of separate them from down payment and closing costs. I think most normal buyers coming in, it's all just one. It's just how much money do I need? How much cash do I need? And so buyers should lump those two together. Okay, so now they're hearing, okay, Bridget, I need 8% to buy a house between my 3% closing costs and my 5% down payment because I'm going to do this type of loan. And they go, holy cow, that's a lot of money. I ain't got that kind of cash. So what options do we have? How can we help a first-time buyer get into a home that doesn't have that much money?
Well, there's a lot of options. One of them is going to be the loan type. So that might be the more simpler way to do it in this market anyways. So there are down payment assistance programs out there. At Bell, we have our own 1% down conventional loan, which is kind of unheard of, 1% conventional, and there's actually no mortgage insurance. So the payment is very reasonable. Yeah. But that's a great way to do it because then all you need is that 1% down and then your closing costs. So 4%. The other thing is there are certain cities, neighborhoods, counties, and the whole state of Minnesota has down payment assistance programs. One that I like to utilize is Minnesota Housing, also known as MHFA, and they're all encompassing of Minnesota. So you can buy in any city, county, anywhere in Minnesota and under this program. So you don't have to worry specifically about what county you're going to move to. And within that program, there's conventional and FHA. And it'll just depend on, your loan specifically and which one best fits you. Almost, I would say like 95% of my clients go for the conventional in that program. And they offer down payment assistance. So most of the time, all you need is $1,000 of your own funds for the down payment.
Sure.
Yeah.
Is that with the seller then paying some closing costs for you too? Or is that total and Minnesota hasn't covered the rest?
So they have limits. Minnesota Housing has limits on what they'll give you. So a lot of times it can cover the closing costs. If it can't, then you will, if you only have the $1,000 of your own funds, then you will need the seller to cover the rest. Okay. But a lot of times we can work it into the loan where it's financed in that down payment assistance loan.
Sure. I love it. Here's something we get asked every once in a while. What if, I got a rich uncle or a grandma or somebody that wants to gift me some funds? Can they help me with a down payment so that maybe I get a better loan than a down payment assistance types? Can I get gift funds?
Yes, absolutely. You can get a gift fund from a family member, a spouse. It can be a grandma, a parent, even a fiance. So the fiance is a little bit of a gray area, but as long as we have a letter stating that you guys are engaged to be married, that works as well.
And you kind of have to have a gift letter stating that it's not a loan, right? We can't be repaying grandma for whatever, right?
Exactly. Yeah. Otherwise, you can't, if that's the scenario and you are going to get it repaid, we just have to count that as a liability against you. But it's a little bit cleaner of a scenario if the gift letter states that it does not have to be paid back, that it's a true gift.
Sure. Yeah. I've seen it too a few times where, grandma doesn't actually care to be repaid, but the person borrowing, they don't feel good about it. So then they'll just sign a letter saying it is a gift funds, which it truly is. But then if you want to repay grandma back in, afterwards down the road, that's your own business. But grandma can't expect to get repaid, or whoever the rich relative is. So
exactly.
I love that. Okay, but what about I'm hearing you have some boxes of cash under the bed stories going on. Does that apparently doesn't work if you got like a shoebox of $100 bills under the bed?
It doesn't work.
Okay, you got to tell us the
Surprisingly.
why though, because people don't understand. It's cash. Like I have to be able to submit cash for everything. Why does that not fly for mortgage people?
It doesn't work because everything has to be documented. So we have to see where did that money come from, and it has to be able to be sourced. So if you first of all, you just can't bring cash to a closing. You can't show up to your title company and say, here's my $20,000 in dollar bills.
Mm-hmm.
Oh, I run into this mostly with servers, people in the service industry, because they actually get a lot of cash tips.
Yep.
And they don't want to claim them. But I would recommend getting that money in your account as soon as possible. So when you're buying a house, not necessarily with your pre-approval, but once you've found a house, you made an offer on it, it's been accepted, we do a 2-month look back. So I will look at your last 2 mortgage statements. So if you found a house today, I will
Bank
likely
statements,
look.
you mean?
Bank statements.
Last
yes.
2 bank
Sorry.
statements. Yep.
I'll do it. Yep. I will do a 2-month look back at your most recent bank statements. So if you found a house today and we're under contract, I will look at your April and May bank statements, and I will see that you have a cash deposit in there. So I would say if you have cash sitting under your bed, get that money deposited into a bank account as soon as possible. That way, when I look at the last 2 months of bank statements, I won't see that large deposit, because otherwise we won't be able to count it. We'll have to throw it out if we can't actually source where it came from.
Sure. Yep. Makes sense. Yep. People are always confused by that one. I had a guy one time, client, that he just cashed his paycheck every single time he got paid and then deposited it into literally like a safe or a box or whatever in his house. And then he was just like so frustrated that he couldn't just like bring his box of cash. I was like, I'm sorry, man. It's called money laundering. Like, we don't know what you've been selling to get that money or whatever. So
yeah. And it's a government thing. It's not the banks picking on you. It's completely a government thing. They put so many regulations on us. We're forced to source all those funds.
Oh yeah. Yep.
Yeah.
And it makes sense. How do we get people started? What's the first step? When do they start? Even if they think they got bad credit, do they need to get fixed up first? Talk to me about how people get started.
I would say talk to a loan officer and apply for a loan. That's the first thing you're going to want to do, is just apply for a loan and have me take a look at it and see if I pull your credit, I can help you get your credit score up, even 10, 20 points, which can make a huge difference. But applying for a loan is going to be your first step.
Yeah, I agree. And I will say, for anybody watching, if you're on my channel right now, you're probably super analytical and you're probably trying to like learn everything or research everything, because that's just my demographic on YouTube, right? But I completely agree, because you're trying to get all these things lined up with generic online information. But once you applying for your loan, like, it sounds really technical. It's literally like you just go on Bridget's website, fill out a form, submit your information, and then she can pull your credit. But then Bridget's going to be able to see, okay, look, we have this credit issue. Or, hey, you're right on the bubble between a 640 and a 680. If you do this, this scenario will bump you into the next bracket, right? Or whatever it is, we can get you into this program, but I've got this one that's better. You guys don't have to do all the research and figuring out what the best route to go is or how to get your credit up. Once Bridget can actually see what your credit looks like, she can help you fix that, or she can help you decide if with how much cash you have, what the best program is going to be for you. And I love people researching online, but I'll also say too, like, if you just apply, then Bridget, it's a soft pull. It doesn't hurt your credit. But that's how we can actually help you move forward. And it doesn't cost anybody anything. Like, you can schedule a buyer consult with me. It doesn't cost you anything. You can apply with Bridget. It doesn't cost you anything. Literally neither of us get paid until if you buy a house down the road. And that's the way our industry works, but it's a great service for you guys. Well, that's a wrap on this conversation with Bridget. Don't forget, this is part of a 3-part series, so you can go see some more great content right here. You'll also find her contact information and mine in the description down below, and we look forward to talking to you very soon.